paper takes a major customer-centric view of supply chain power and examines it in the context of real earnings management. And I would describe this as instances where managers either execute or forego operations transactions with the sole purpose of meeting or beating earnings targets. We specifically examine whether powerful major customers exploit their positions in the supply chain to engage in a greater degree of real earnings management than less powerful firms. We further explore some of the financial performance implications of this behavior, which would include stock market reactions, the future performance of the major customers, and the consequences of that behavior on their captive suppliers. The background of this paper is pretty interesting in that it bridges together two seemingly unrelated streams of research. My colleagues and I were looking at two different areas. We were looking first at the real earnings management literature for a different project. And in that literature, in a nutshell, it examines the mechanisms that managers use to alter their operations to hit earnings targets. And this would include behaviors such as offering late-term discounts to customers to boost sales at the end of the year, cutting discretionary expenses such as R&D, advertising, and selling and general administrative expenses, and finally, overproducing inventory, which basically is a way of reducing unit costs and cutting and reducing cost of goods sold. All of these things, research has shown occur around earnings targets, such as avoiding losses, meeting or beating prior year's earnings, or even analyst forecasts. However, they also find that the market perceives this as value-destroying behavior, and evidence has shown that the market will discount earnings benchmark beaters if there is evidence that they did so using real earnings management. On the other hand, in the supply chain literature, including a study that we published, we find that major customers in the supply chain, large buyers in the supply chain, have improved performance. Interestingly, because of their ability to reduce discretionary expenses, because of their ability to negotiate favorable price terms with their suppliers, which allows them to pass on savings to their customers in the form of discounts. And if they wanted to overproduce, or for whatever reason, if they needed to expedite shipments, right, their positions in the supply chain as large buyers would enable them to place those demands on the suppliers. Another interesting note is that the market prices these firms favorably because of this operating advantage. So when looking at them, just sort of an aha moment where it's like, wow, the things that major customers, where it's viewed as an advantage and an operating advantage leading to improved performance and higher valuations, other firms who engage in a similar behavior opportunistically around benchmarks, it's viewed as value destroying, but they look very similar in terms of their outcome. So that's really how the story came. It was literally an aha moment by two streams of literature that we were looking at the same time. Well, in terms of our methodology, our tests of real earnings management, including the proxies for real earnings management, the cross-sectional regressions, and even our market tests closely follow what's already in the real earnings management literature. So I won't get into detail there, but I do want to talk about our sample, how we collected our sample, and how we constructed our proxy for supply chain power. Right. Accounting regulators require that firms disclose the existence of a major customer in their financial statement footnotes, and where a major customer is defined by the regulators as any individual customer that constitutes 10% or more of a supplier's annual sales. So to the extent that the supplier discloses the existence of a major customer and further reveals the identity of that major customer, that allows us to collect our main sample of major customers. And in addition, it allows us to determine the number of suppliers naming the same major customer as such in a given year. And this leads into how we construct our proxy for supply chain power, which is based on our position that supply chain power is increasing in the number of captive suppliers naming that firm as a major customer in a given year. And we support this in part due to the reasons why accounting regulators require this disclosure by suppliers. That it is viewed as a concentration risk of having a single customer that powerful that if that customer is lost, that could have some significantly adverse accounting consequences. So we believe that this is a valid yet simple but valid construct. The other thing I want to add is that our control sample, so we have our sample of major customers and our proxy for supply chain power. Our control sample would include industry peer firms who are not named as major customers in the same year. Well, our main findings, we find evidence that suggests that major customers do exploit their supply chain position to engage in more real earnings management. And we use a composite measure of real earnings management, and then we break it out to look at the different forms, whether it's overproduction or cutting discretionary expenditures. And we find evidence to support that there is an even more pronounced effect when we interact, the benchmark behavior with our proxy for supply chain power. In terms of performance consequences or performance effects, we find that unlike the market skepticism toward real earnings management behavior among non-major customers, that there is no discounting effect when major customers engage in real earnings management around earnings benchmarks. This suggests that the market views major customers' behavior as more legitimate execution of business practices than the value destroying perspective they take for non-major customers. We also find that major customers' financial performance does not decay as it does for non-major customers. And when we view it, when we invert our perspective to view how this affects suppliers, we find that the form of the major customers' real earnings management is what affects the suppliers. In other words, the nature of the consequence is largely dependent on the form of real earnings management. And specifically, we find that when the form of real earnings management is reduction of discretionary expenses, that is associated with a deterioration in suppliers' contemporaneous performance. However, we find some evidence to support that overproduction on the part of major customers improves the performance of suppliers. Well, I would say that practitioners, if you're viewing it from the perspective of practitioners, in a major customer position, that it suggests that in addition to the operational advantages of being a large buyer in the supply chain, that there are other benefits of consolidating your supply base, that it could allow you to hit short-term earnings objectives, right? So that's one perspective. Looking at it from the perspective of a supplier, it suggests that not only are suppliers, do they need to anticipate the normal day-to-day demands placed on them by major customers, but they should also, be mindful of the fact that sometimes, toward the end of the period, there may be some disruptive demands that come in the form of, accelerated things or things that are out of ordinary because the major customer is trying to hit an earnings target. think that there are a number of future research questions, and in part, due to our own limitations in the research. One of them could take a more refined look at the types of suppliers that are naming these major customers to determine whether there's a variation in terms of the consequences based on the supplier type. So we found some evidence suggesting that the form of real earnings management was associated with differences in the consequences, but we didn't look at, what type of supplier there is. So that's one possible stream of future research. Another could look beyond real earnings management and ask, what other market advantages do major customers have, right? So we are finding that, the market does not appear to discount their behavior around earnings benchmarks, even if, at least, looking at it from, bird's eye view, it suggests that it's opportunistic behavior, right? What other advantages do they have that they could possibly exploit or strategically implement? So that's another thing. So stepping outside of the real earnings management. So I think that those are certainly two areas that could be explored.